Corporate insiders are selling at the most rapid pace we've seen over the last year. This is a data set that's released weekly, and it shows the ratio of corporate insiders that are buying shares versus corporate insiders that are selling shares. When this ratio is above 20, it's supposed to be a bearish signal for the market because it means that corporate insiders are selling their stocks. And when this ratio is below 12, it's supposed to be a bullish signal for the market because it's telling us that corporate insiders are buying up their shares. Today, the ratio is at 150. I've personally never seen this ratio go above 50, so it's a fair question to ask whether this is a signal that high-level corporate insiders have access to inside information that's making them sell at a historical pace today. Corporate insiders are typically executives and board members that have intimate knowledge of their companies. Many believe that insiders selling their stocks at a historic pace today is a big warning sign for the stock market. To provide some context, popular news outlets have been talking a lot about a soft landing recently, which is a term to say that the economy is avoiding a recession. The number of news articles mentioning this term is at the highest level since 2007 and 2000, both moments when popular media was talking about the economy avoiding a recession right before recessions actually materialized. Could it be that insiders are selling today right before a recession actually materializes again? When we look at how well they performed in 2023, we see that insiders sold their shares in January, in April, and in June of 2023. And they were buyers of the market in March of 2023, in May, in August, and October and November right here. When we look at what the market was doing in those instances, January, April, and June were pretty good moments to be selling the stock market back in 2023, while March, May, August, and October were pretty good moments to be buying stocks when insiders were buying as well. So given their good track record, does the historic amount of selling that we're seeing from corporate insiders today mean that we're going to get an equally proportionally sized correction on the stock market? Not necessarily. You can see corporate insiders just have the tendency to sell their stocks when the market is rising very aggressively, like in these moments right here, and to be buying up their stocks when the market is selling off. And considering the market doesn't go up in a straight line, it looks like insiders know when the market is going to fall, but most of the time that's not the case. They just know that their business doesn't change significantly from week to week. And so if the price of their shares goes up by 10%, it could be a good time to book some profits. And when their stock goes down by 10%, it's probably a good time to be buying up those shares. And given that the stock market is incredibly strong since October, posting a 20% return just over the last few months, it only makes sense that corporate insiders would be taking advantage of that to sell some of their stocks. This stock market rally was purely fueled by the Federal Reserve announcing that they would be cutting interest rates back in October of 2023. They clearly stated that 2024 would be the year where the Federal Reserve finally begins to cut interest rates again, and Wall Street tends to get very excited about that. This is what's known as a Federal Reserve pivot, and in most cases, the stock market does rise following these Federal Reserve pivots, and the rally that we've seen since October of 2023 has been the largest Fed pivot rally in history so far in the first 3 months, with almost a 20% jump in the S&P 500. But corporate insiders who haven't necessarily seen anything change in their businesses during that period of time are probably taking this massive rally as an opportunity to sell their shares, which could suggest that insiders are just doing some healthy profit taking, and when the market does pull back a little bit, that they will be buying back up their shares. One alternative is that corporate insiders believe that their company has become too expensive relative to what it's worth. The stock market as a whole is getting quite expensive today. When we look at forward PE ratios, it is at one of the highest levels in history, which reflects that investors are very optimistic on future economic growth. For example, in 2020, investors were willing to pay a lot to own the stock market because they saw trillions of dollars being injected into the US economy, and they believed that this would create a massive economic boom, and that actually materialized. Today, PE ratios are almost at the same levels as 2020, so reflecting the same type of optimism about the future, but corporate insiders may not be feeling this same type of optimism and feel instead that their company is too expensive on the market and that they want to be taking some profits off their shares. Now, just because they believe valuations are too high doesn't mean much in terms of timing the stock market. As we saw in 2020 and also in the late 1990s, valuations can keep on rising. The stock market can stay irrational for extended periods periods of time. In the late 1990s, that lasted for around 3 years before valuations finally began to turn around. But it is known that we had lots of corporate insiders selling their stocks back in 1999, and it's possible that something similar is happening today. Growth stocks have outperformed value stocks by a staggering 30% over the last 12 months, which is a number that has only been achieved a handful of times in the past, including 1999, but also in 2021, we had such an extreme reading, and we know the likes of Bill Gates and many other tech executives were selling their shares back then. In fact, they were doing so in late 2021, right before the stock market dropped around 20% throughout 2022. Quite often, these periods where technology stocks have outperformed significantly are followed by big periods where they actually end up underperforming. So again, it may not be that insiders know something, but that they're just booking profits after a big surge in their stock's price and valuation. But is it possible that they actually do know something, similar to December of 2021, where corporate insiders sold at the very top of the market, that their timing is spot on today as well? Many are pointing to the yield curve that is steepening today as a signal that insiders are betting that a recession is getting a lot closer, something that has happened right before every single recession in history. We see this type of yield curve steepening, and when these traders are starting to bet on that, it usually does mean that a recession is really not far away, and corporate insiders may be connected to those very same people who are placing these bets. Now, although we'll never really know for sure why corporate insiders are selling, we're seeing some pretty concerning signs in the economy today, with the number of people that are residing in states with rising unemployment that is currently spiking. Now, every time this has happened in the past, it's usually right before a recession occurs. You systematically see this chart rising, and then a recession materializes. And it actually tends to happen when the real unemployment rate that you see here in black is still quite low before the recession actually happens. And of course, there are exceptions. There are what you would call soft landings on this chart, where you did see this data set spike, but no recession actually materialized, and the unemployment rate just continued to go lower. But it would be the first time that we see the labor market weakening to this extent without seeing a substantial rise in the unemployment rate in the couple of years that follow. Now, that doesn't mean all of that is going to happen in the next couple of months. In fact, before the stock market peaked in October of 2007, the labor market started to weaken like today in October of 2006. And in the near term, that was actually a pretty good thing for the market over the next year. If we're following the same template as many recessions that have occurred in the past, the very slow-moving aspect of the business cycle could mean that we'll see more weakness in stocks in the second half of 2024 rather than the first half. And we'll be actively working to find every possible trading opportunity over the next year. Make sure to join our community if you want to have access. You can test out our service completely for free for 7 days.